Welcome. In this video, we will talk about something absolutely critical for everyone: choosing the right kind of financial advice. Do you sometimes feel overwhelmed while making financial decisions? Like, which is the best bank loan for buying a new house? Which is the best insurance policy for you and your family? How should you invest your money? Financial decisions are among the most complex and impactful choices we make in our lifetimes. Choosing investments, planning for retirement, or getting a home loan can be overwhelming because they involve a lot of financial terminology and calculations. For example, compound interest, time value of money, and risk diversification are the basic concepts we need to make optimal personal financial decisions. What makes financial decision making even more challenging is that these decisions have long-term consequences for us during and even after our lifetimes. On top of that, our cognitive abilities decline as we age, and it becomes harder to process complex financial information. So what can you do to make these decisions peacefully and confidently? The solution is simple. It is to seek advice from experts. Good financial advice can somewhat substitute for lack of financial literacy in our society. However, it is often challenging to find a reliable financial advisor. We often reach out to our friends, family, or colleagues for references, and most often contact the first advisor recommended to us. We lack the ability to comprehend the intricacies of the advice and have no option other than to trust the advisor. In India, you can reach out to financial planning advisors like registered investment advisors or RIAs and certified financial planners or CFPs. Now let us assume that you found a financial advisor who is willing to help you with planning your personal finances. And that is great. However, today I want to present to you the next challenge you will face. Not all financial advice is created equal. I would like to draw your attention to the type of compensation your advisor receives. You must realize that this compensation can significantly shape the advice you get. Let us look into the details. There are two modes of compensating a financial advisor. One is through direct fees that you pay your advisor for receiving advice. This model is often considered more transparent and less prone to conflicts of interest. The second is through commission paid to the advisor by financial product selling companies like mutual fund houses, insurance companies, banks, etc. This second model may lead to biased advice, as the advisor may recommend products that offer higher commissions, even if they are not the best suited for you. Imagine this scenario. You are not sure about a financial decision in your life. For example, financial planning for your retirement. You try to understand the details of all retirement-related products available in the financial markets, but you find them all to be complex. You do not have the time and mental bandwidth to comprehend these complexities. So, wisely, you decide that it's time to get help. You reach out to your network of friends and family who recommend two different financial advisors. Let's call them Advisor A and Advisor B. Advisor A explains, quote, "My services come with a fixed annual fee that you will have to pay me directly. I will charge you 10,000 rupees to implement a comprehensive retirement plan for you. In the subsequent years, I will charge 5,000 rupees to review and update the plan if and when required. I'll help you create a roadmap based on your expected expense requirements without the pressure to buy specific financial products." You heard Advisor A carefully, but also wanted to explore what Advisor B had to say. When you go to Advisor B, he says, "You came through the reference of a close friend, so my services are completely free for you. Don't worry about paying me anything. I am actually paid by the mutual fund houses, insurance companies, and banks." You come back home and are trying to choose between advisor A and advisor B. Is this a confusing choice for you? Do you want to pay for the advice, or do you want to take the free one? Well, advisor B's offer seems like a great deal, doesn't it? After all, who doesn't like free things? But I am here to warn you that there are no free lunches in this world. I urge you to think carefully. Why is advisor B offering free services? Advisor B's earnings depend on selling specific financial products. The higher the commission he gets from selling a product, the higher is his income. This can lead to a conflict of interest because advisor B is incentivized to recommend the products that give him the highest commissions, which might not be in your best interest always. On the other hand, the income of advisor A, who charges you a fee, is tied solely to providing sound advice. Now let's look at how these incentives can create a mess for you. Imagine advisor B sitting down with you and recommending a new mutual fund. He tells you it's the best option for financial growth. He doesn't mention that the mutual fund pays him a fat commission every time he sells it. So what's happening here? Instead of prioritizing what's good for you, advisor B focuses more on what's good for his pocket. The problem here is called incentive misalignment. Well, it's a fancy term, but the idea is simple. Your interests and your advisor's interests are not on the same track. For example, you might have heard about unit-linked insurance plans, or ULIPs for short. These are popular investment choices in India, but are they really as great as they are popular? ULIPs are complicated insurance policies bundled with investment plans. These plans pay high commissions to the selling agent. And where does the commission come from? It comes from your pocket, the one who has bought the policy. And what is worse is that these policies neither serve as good insurance nor as good investment. Researchers studied the ULIPs in 2010 and found that both LIC and ICICI Pru agents pushed ULIPs hard, even when simple term insurance would have served the client's needs better. Why did the insurance agents do so? Because these plans pay high commissions. As a result, people paid higher premiums and earned lesser interests. Let us talk about another real-life example from Canada. Researchers looked at the behavior of 6,000 financial advisors who together advised around 6 lakh clients. They found that commission-based advisors often recommended investments with higher fees and were less diversified, which meant that clients made 2.5% less each year compared to well-diversified portfolios. Now, 2.5% might not sound like a great deal at first, but over 20 years, that can reduce your savings by almost 40%, a staggering 40%. Can you imagine that? That is the power of compounding. And it's not just about insurance or mutual funds. It could be tax saving schemes, alternate investments, stock trading platforms, banking products like savings, loans, or any other financial product. Commission-based advisors have a built-in temptation to push products that give them bigger commissions. You may not realize this, and your advisor might not tell you this either. This is why choosing fee-based advice can make a big difference. With a fee-based model, you know exactly what you're paying for, and your advisor's only incentive is to help you reach your goals. No secret commissions, no hidden fees, just straightforward advice. But the responsibility of choosing the right advisor falls on you. When you meet an advisor, ask them how they are compensated. Are they getting commissions from the products they recommend? Choose someone who is transparent and prioritizes your interests. Just like in healthcare, where good advice is about your overall well-being, in financial matters as well, it should go beyond just fees. Financial advice should be rooted in trust, transparency, and a shared commitment to your financial well-being. Thank you for listening.